Hi, welcome to another series of podcasts. Today we have a very special guest, Mr. Aashish Somaiyaa, CEO of WhiteOak Asset Management. Welcome, Ashish.
Thank you. Thanks for
Yeah,
having me.
it's pleasure to have you. Someone who's been in the market more than 2 decades, as of 20, 25 years. We go a long way. I know Ashish for almost now more than 2 decades. Very very senior hand in the industry. WhiteOak as asset manager, asset management brings a lot of experience in managing global investors' money. One of the largest foreign investors investing into India. One of the fastest growing asset managers. Ashish, I know we are in a doing this podcast at a time when geopolitically a lot of things are happening.
Yeah.
Yeah, more I'll rack your brains on these things. Couple of topics which are of interest to our investors also,
Yeah.
and address right on bang on. So what's your overall take, especially keeping where crude prices are, global markets, currency also, because a lot of investors investing into India
Yeah.
also factor the currency side of it.
Yes.
Where do you see how things are going looking, from here on, or
Yeah.
where we are at current juncture?
Pratik, I think since you yourself deal with a lot of global investors, especially non-resident investors, let's talk about the currency first. Because I think that generally I've seen that when NRIs and foreigners look at India, they think of the Indian currency purely in depreciating terms. And I think in the last one and a half year, we have seen two, three things happening. One clearly is that somewhere during the election season in 2024, I think because the government was a bit out of action, and I think RBI policy was also quite tight. We saw a slippage in the GDP growth. We saw slippage in corporate performance.
Right.
And I think that caused fair amount of FI outflow from India. The second is obviously that a lot of new age businesses got listed. And you know that global investors, private equity investors, they are very big in these new age businesses. So, there is a repatriation because, they invested 10, 15 years back in India, a few $1 billion, and now tens of $1 billions is being realized in terms of gains, which is a happy event to happen, but the net FDI has been negative as a result of that. So that is the second reason. And third, of course, India was not seen to be as an AI trade. And hence, so for all these three reasons, economic slowdown as well as some outflows and not being part of the AI trade, I think we have seen a slippage as far as the currency is concerned. And for the long point in time, also the headwind of not having a tariff deal. So these things caused currency to slip. But I would tell you that in the past, whenever these kind of economic episodes have happened, people tend to forget, but the currency has had a whiplash and moved back very rapidly. So I'll give you a few examples. If you see before the Lehman crisis, rupee was at 42 or 43. In the midst of the crisis, it went to 49. But when the US economy actually slipped into recession, the rupee went to 38.
Right.
I'll give another example. When there was a taper tantrum and when India was seen as fragile pie, for example, in 2013. In 2013 August, rupee was 69.
Yes,
Okay.
that's when I started the career, actually, 2013.
Yeah, so in 2013, rupee was 69, and today we are 90, 91. So in about 13 years, the rupee has slipped by, say, more like, you can say like 20, 22 bucks, right? As even in 2018, rupee was 62 or 63.
Yeah.
Correct? So what I'm trying to say is that, and even in after COVID, we saw rupee appreciating.
Yeah.
So my net sense is that if we have the same conversation 12 to 18 months down the line,
Yeah.
I think the rupee would have appreciated significantly. That's my view. Now coming to the geopolitics, I personally feel that it's very very difficult because right now we are in a scenario which is a developing scenario.
Right.
Times like this, I think, other than the impact, the collateral damage of energy prices, India doesn't have much direct impact, so to speak, right now. And if Indian market declines because of external environment, say for example, we are not directly impacted other than the collateral damage of energy prices. And second thing is that the India of today is not the India of 2002 or 2008 or 2012 even because our dependence, the import-export balance, the trade balance has changed. The oil intensity of our growth has also changed. Alternate sources of crude supply, alternate sources of energy. I think on many of those things, India's sensitivity to oil prices has actually kind of gone down. You might recall in 2022, oil prices went to $130. Right. And Indian market eventually just bounced back. So my sense is that when two things to keep in mind right now for global investors. you're going to enter India at a time when currency is close to its lowest.
Yes,
You're going to enter India when market has underperformed for 18 to 24 months compared to other emerging markets.
absolutely.
You're looking to enter at a point in time when India's domestic conditions are improving significantly. And the last thing is you're looking to enter at a point in time when we are not directly involved in geopolitics, but we are just a collateral damage. So I have seen that whenever India's market declines because of external environment, that's a great entry point.
Entry point.
And I will not give, so to speak, long-term gyan. Even if we meet 12 to 18 months or 24 months later, you might find the market in a much superior position and the rupee probably appreciating.
Appreciate it. That's a valid point. I don't completely agree. And what you're talking about, the dollar rupee depreciation, we have had instances, with when I started Alphabet, I remember rupee was 69, and then obviously it appreciated. But if you look at over 10-year period, then depreciation is 2-3%, which
Absolutely.
is reasonable, And Ashish, just to continue on point which you said, India is looking much better. When I feel what government has done in terms of reform in last 18 months, as you said, post-election, last year, November, December, they realized they need to get back economy on track. Whether it was income tax limit going up, GST rate cuts, or, maybe interest rates coming down in India. Are you seeing, because you do interact, your team interacts, especially your investment team interacts with the companies, you're seeing ground level, numbers and the consumption side picking up, things are moving. What's your view on the earnings and the,
Sure. So, one thing you said very interestingly that over a period of decade, couple of decades or longish time frame, the rupee has depreciated maybe 3% or something. And I think all your global investors should know that over the last 20 years, after dollar depreciation, so if we report the numbers in dollar terms, over the last 20 years, India has delivered 10% compounded in dollar terms.
Wow.
So after rupee depreciation, it is 10% compounded. And that is on the index, not on any scheme which you might actually.
Active funds have done much better. Absolutely.
That is one. Now coming to, the here and now about the numbers, I think you're bang on the dot that in last 18 months, many things have happened. First is that RBI's policy, because RBI has become a bit more growth focused, right? A bit more accommodative as compared to what it was 18 months back. So you can clearly see the liquidity scenario has changed. You can see they have reduced interest rates. And most importantly, they've liberalized, they're pushing banks to lend more. So that is the entire RBI stance has changed. If you see government itself, income tax cuts, GST related, reforms and rationalization. And now the government is obviously due to announce the 8th pay commission. And in the past, it has been seen that when the government gives a pay commission hike to millions and millions of government employees, that itself addresses part of the question about boosting up consumption. Apart from tax and GST and RBI policy, I think pay commission will also be a significant driver for discretionary consumption. As far as results are concerned, we can clearly see that compared to 2024 and early 2025, I think 2026 calendar year has started on a good note because we can see that the earnings are becoming broad-based. Right. If you look at mid caps, if you look at small caps, I think on the margins there is significant improvement, and earnings are widening. Right. And you can clearly see that India overall the nominal GDP rate itself, growth rate itself is likely to end up in low double digits. And generally one has seen that when the nominal GDP growth goes back to 11-12%. You can see on a broader base earnings also going to about 12-15% kind of growth. So I think we are in for some good times. And this macroeconomic hiccup, which is holding us down on valuations, is actually probably in hindsight will look like a good entry point.
And Ashish, it's very normal, being outside investor, they generally track the larger index, whether it's Sensex or Nifty, they don't look at broader market, But we have been seeing, that broader markets have actually corrected more than the index reflects. So probably people might think index are at the same level 1 year down the line, but actually the opportunity remains in the broad market. And that again, follow-up question to would be, always, we have had this discussion before, the active investor versus, a passive fund, so I feel as a probably from, and over to you on this, where do you see, opportunity in terms of, market probably from a
So, since you are dealing with global investors, they have a lot more exposure and, I think the American experience teaches them or maybe even partly European experience might be telling them to invest with passive. But I would just draw out 2 or 3 things where India's market is different. See, first of all, I'll just make a statement that do not worry about index capturing the market before the market captures the economy.
Right.
So if you see last 7-8 years, Pratik, you must have noticed, your investors must have noticed that entire sectors which were not even listed in India, they started getting listed. Right? So you see diagnostics, hospitals, you see our sector, asset management, wealth management, broking. You see many areas of chemicals, auto ancillaries, right? Construction ancillaries, capex and defense ancillaries. Entire sectors which were never listed, they were listed in last 7 years.
Absolutely.
Now, things which are not even listed, how are you expecting them to get into the index?
Yeah.
Right? Even insurance, for example, was not listed in India till mid 2010s, 2015, 16, etc. Right? So, first is that in India, lot of companies are still getting listed. Companies with 3,000, 4,000, 5,000 crore market cap are still getting listed. Entire sectors are coming to the market for the first time. And the investment universe for active managers is consistently expanding. Right. So what I feel is that there is still a lot of potential for active managers to add alpha in our economy, and hence there is scope for active. So there'll always be good fund managers and not so good fund managers. So the role of a wealth manager in giving the right kind of funds to the client, that still remains. But if you put some effort, if you deal with the right advisor, if you pick the right fund managers, make some effort on that, follow some process, you will be able to find alpha. Sure. Because the market is alpha rich. Now you need the right partners to execute.
Absolutely. So that comes to, a question of, Ashish, where is WhiteOak? I know we have been doing WhiteOak funds, recommending to our clients, So as a fund house, we would like to, little bit in terms of understand, probably where you see market or, from a return point of view, or what are the areas, one should, or fund perspective,
Yeah.
you are already present in Gift City also,
Yes.
where a lot of offshore investors can access, so probably multi-cap as a strategy,
Yes.
you already have that WhiteOak, and you also have our emerging fund also on the global side. That will be probably a follow-up question. But
Sure.
yeah.
So, like you were kind enough to point out, we are one of the largest, actually the largest research team for an equity fund house in India. I mean, totally, we are more than 50 people engaged in fund management and research. And like you said, maybe lesser known fact, WhiteOak, raises money all over the world and invests in India. And of course, we also manage money in India domestically. Plus, we manage money which is deployed in global emerging markets. So invest all over the world. And we have our research teams, investment teams in India, in Gift City, of course. Because we cover Latin America, we have Spanish speaking teammates in Madrid, for instance. And we have a significantly large presence in Singapore because, we have, Asian nationals who cover, high technology, semiconductors. Then we, of course, have, investors investing, investment team members investing, like I said, in Latin America, in other parts of Asia, Eastern Europe, Middle East, all over. So very large research team. We manage, say, over 11 to 11.5 billion dollars.
Wow.
Everything in equity, right? Now, and I think that for people who are investing globally, global investors to invest into India, I think Gift City is quite a boon because I think it's the most frictionless, most tax, tax efficient, meaning tax free way of investing into India, right? So clearly, I think non-resident Indians especially should consider that route.
Yeah.
And we ourselves, we always tell people that when you are investing, you're a foreigner or an NRI, a global investor investing into India, you don't need to really slice and dice it further. You need one multi-cap fund, which invest across sectors and invest across large, mid, and small, right? So we have just one fund, just one multi-cap fund through that Gift City gateway, giving you broad exposure into India. And just within India itself, we have 35 people covering Indian equity. Wow. I mean, our overall investment team is more than 50. But India equity research itself is more than 35 people covering some 1,100 companies.
Oh, that's great.
So we have the widest coverage here. And we have just one fund which covers the spectrum.
Yeah. So that's very good to know. And I know most importantly, what Ashish highlighted for a lot of our NRI and offshore investor, investment via Gift City into mutual fund of fund is completely tax free. So you get that advantage of not paying any capital gain tax, whenever, you book the gains. So that's a big advantage, especially for NRIs. vis-a-vis investing via domestic NRE route. Ashish, and also, now, obviously, a lot of global funds in India,
Yeah.
especially mutual funds have not been able to take money because of the, restriction on the RBI
Yes.
limits and, but, especially, you have high net worth individuals in India
Yeah.
who want to obviously now diversify their portfolios and, obviously people, now to great extent, people are aware about the LRS scheme.
Yes.
But, that's where I feel GIFT City becomes an important jurisdiction for Indian investors to, diversify also. And I'm sure global investors can also access this fund, over a period of time
Yeah.
to invest and diversify their portfolios. I know your fund has done very well. You want to talk out a little bit about
Yes, yes. Yeah, no, thank you. So, see, I would always tell people, like, first, let's talk from Indians' perspective.
Yeah.
Now, lot of people who are, I mean, all the people actually who are in India, like you, me,
Yeah.
everybody, it's but natural that we are overexposed to India because we have a home country bias. I mean, we are based in India. India is the market we can most relate to, most easily research, and we understand better. So I think there's nothing wrong if I say that bulk of my money is invested into India because I am an Indian investing in India. But it is also true that ultimately India is some 3% of world market cap, right? And a small percent of the world GDP. Right? Everything is low single digit. Whether you look at world GDP or you look at world market cap, India is a low single digit percentage, which means that there is a much bigger world outside economically. So I always tell people that if you're an equity investor other than India, you should invest in US and you should invest in emerging markets other than India. Right? Now, US is a topic for another day. I personally feel it is a bit toppish. But I think that people should consider investing in emerging markets other than India for a simple reason that if you see, India is known to be a large domestic market. And our correlation with the rest of the world is quite low. Which automatically means that there will be phases like 2025 when India gives practically no return, but other emerging markets might be doing well. And there are reasons for this. So today, for example, one of the things we are worried about is the energy prices. What if the war prolongs? Energy prices go up. There are other countries which don't do that badly when energy and commodity prices go up. For example, Brazil. Right? So what happens is that India doesn't do too well if oil and commodity prices go up. Typically speaking, not during this war, but typically speaking, if oil prices go up, Middle East would do well. If oil prices go up, Brazil would not be impacted like India. Right? So commodity-driven markets, like China does well if commodities go up, but in India, it's a questionable thing. Right? So if you invest in emerging markets other than India, you get exposure to oil and commodity, which in India is a sore point. It's not there. Second thing, we just spoke that last year there was this big AI move. Now, when there is a frenzy to chase AI, US did very well. But other than US, it was China, South Korea, Taiwan. India is not a tech market.
Was
South Korea. Because they are seen to be tech markets. India is not a tech market. Then I'll give another example. If you talk about India as a domestic economy, but India is not alone the domestic economy. Right? China is a big economy. Latin America has big countries like Mexico. So there are other domestic economies. So the point is that India's correlation with the rest of the world is hardly now 0.6. Which means that if you invest in emerging markets other than India, it's a great diversification for you. And it stands to logical reason because the diversification comes from technology exposure, commodity exposure, exposure to domestic markets other than India's market. There is a sound reason for investing in other emerging markets.
And more importantly, from Indian investors' point of view, we tend to spend a lot of our money in dollar now. As Ashish and we are saying, as our middle income grows, people tend to travel more. They send their kids abroad for education. So it's good hedge to have a portfolio in dollar.
And even people who are living outside India, like I said, that why Indians should invest in other emerging markets. Even people who live outside India, they also have seen when I meet people in the Middle East or in Africa or these places, when they invest abroad, largely their exposure is US. Whereas actually it's not just US. Even foreigners should be investing in emerging markets.
Absolutely. Now that makes sense, So Ashish, now, since we have had broad discussion, I'm going to talk a little bit, away from the equity. What's the view, as an investor, how do you diversify your portfolio, because we don't know, there's a jigsaw puzzle, what's going to happen to energy prices, what's going to happen to equity. So as an investor, you should look at, probably beyond equity to gold, silver, or
Yeah.
and we have seen time and again, which we keep on advising our investors that don't invest out of just FOMO,
Hmm.
what we call it. So we have seen what has happened to silver prices.
Yeah.
They are down almost 40-50% from the peak. So, but today where we are, how do you see probably one has to plan from a diversification asset allocation? What is that? You know,
See, if you are, see, there is one thing to always keep in
yeah,
mind. Let's look at some big corrections, for example. We all know that if you look at an Indian context,
right,
the worst decline in equity was about 60% in the financial crisis.
right,
2008 peak, 2009 bottom, equity fell 60%.
right,
If you look at gold and silver, the worst corrections were somewhere around 2015 and 2016.
right,
Now, if you talk of worst corrections, I said equity, the worst correction is 60%.
right,
Silver, I think the worst correction, gold worst correction was 25%. And silver, I think the worst correction was down some 40-50% or
right,
something. In the worst case, when equities fell, despite 60% being the worst fall, it recovered in 19 months.
right,
Silver, when it had the worst fall, it took 5.5 years to recover the price.
right,
And gold, when it had the worst fall, it took 3 years and a quarter to recover the peak
right,
price. So one can understand that if gold and silver are precious metals,
right,
still they took 4 years, 3 years, 5 years to recover. And equity, which is considered to be risky asset, how did it
yeah,
recover in 19
right,
months? Reason is very simple. The people who understand economics, people who understand corporate earnings, they understand that equity ultimately is powered by economic growth and earnings.
right,
So if companies are earning, let's say another example. We're sitting in this beautiful building, beautiful office of yours. It's a commercial tower.
right,
As long as this commercial tower is occupied and people are paying rent,
right,
there is a limit to how much the price can fall. Beyond the point, it cannot fall because there are tenants who are paying rent.
right,
Same way in equities. Beyond the point, price cannot fall because ultimately companies have assets, companies have earnings,
right,
companies have cash flows, right? So equity is the supreme asset class because it is powered by earnings and there is a implicit downside protection. But what happens with gold and silver? Gold clearly no earnings, right? It comes into play when there is economic distress. It comes into play when people start questioning the fundamentals of economics. Then gold comes as a
right,
silver is a bit mixed up.
right,
When gold goes up a lot, then people move on to silver. And then every time silver comes in discussion, people say, oh, it has industrial use.
right,
That's a fallacy. That's a pitfall. The fact that it has industrial use and people cite industrial demand,
right,
automatically it means that if you are citing industrial demand, then you should be prepared that demand can go down also.
right,
And that adds to volatility, right? So if silver has industrial demand at 50,000 rupees a kilo, I can understand.
right.
But if you apply that logic and say it has industrial demand at 450,000 rupees a kilo, then any industrialist will tell you, no, it doesn't work that way.
Doesn't work.
Right? So I think that, first of all, if you understand the economics and if you understand the long-term fundamentals, nothing beats equity.
Absolutely.
But every once in a while, equity goes down 20%. And people can't digest that.
Right.
So to diversify from equity and to add a cushion to the downside, they need gold.
Yeah.
Silver, I feel, is a questionable, if you have an understanding of silver and a view on silver, you buy silver. But don't tell me it's a precious metal and it's a hedge.
Yeah.
It has never worked as a hedge. The only thing which has worked as a hedge is actually gold. So if you cannot digest the volatility of equity, maybe you need some gold in the portfolio. But if you are somebody who can sleep peacefully irrespective of where equity prices go, and if you're a believer in long-term fundamentals, then you don't need anything, just remain in equity.
Yeah, yeah. And last 3 years, we all have been proven wrong with our wives and moms, with the gold price where they are today. Just on a lighter note. Ashish, it's been wonderful having you. But I'm going to add with end this session with a quick fire chat, 5 questions, just yes, no, or what do you think, this will be like a quick one. So what do you think 2026, year of India or global?
I think next 3 to 6 months it will remain more, you will see more of the same, directionless. Yeah. By the time the year ends, India will stand out.
Wonderful. Your personal view, equity, gold, silver, money?
Equity. I mean, you stagger out over the next 6 months, but equity.
Equity, okay. For NRIs, offshore investors, come via Gift City, India? What is the better option?
No, I think for NRIs to invest in India, Gift City is unmatched. Is the best option.
Thank you. And WhiteOak, one fund we have to look at,
See, I always tell people don't get into sector, theme, large cap, small cap. Just one multi-cap fund, enough.
Perfect. Thank you, Ashish, for
Thank you.
having your time out. Thank you so much.
Thank you, Pratik. Thank you.